Hi, guys. Welcome to the Scalp University. Thank you so much for being here. I'm super excited to get into this course and teach you guys all how to scalp. Um, I've been scalping for the last 2.5 years. I started my trading journey back in 2018. And at first, I wasn't exactly sure what type of trader I was at the time. And that's okay if you are a beginner or you're not quite sure on what style you want to stick with. This strategy can also be used for intraday trading as well as swing trading. But I personally find that it works very well with scalping. Also, being that I did decide to stick with scalping as my style of trading. But you can definitely use this strategy or concept with intraday or swing trading as well. As many of you all know, I do trade GBP, USD, and US 30. So those are the two main pairs that I've been consistently trading for the last 2.5 years. And I also added gold on there because I have added gold to my list. I've been trading it for the last few months, and I really like how it moves, especially with scalping and how it reacts to liquidity. So I really like that. So I'm going to start trading gold as well. And the sessions that I do scalp or trade on would be Asian slash pre-London session. I'm usually able to find setups nowadays before London even opens. So I start looking for setups probably like an hour, maybe 2 hours before London Open. Being that I do scalp, I'm able to find pretty decent moves. And I do find that trading gold during the Asian session is a lot better than during London. So I find gold has great moves during Asian. So I've kind of just stuck with that. I've been testing it for a few months now on gold trading Asian session. So I normally just stick with that for gold. There is times where, I may find a gold trade during London. If I don't find anything during Asian, I will see if there is a setup during London, but normally I would prefer to trade gold during Asian session and GBP USD definitely during London if I'm not able to find a pre-London move. So those are the two pairs that I would suggest, especially with scalping, to look at during Asian pre-London or London opening for those two pairs. And I used to trade US 30 during London session. I mean, I still do. There are times where US 30 does have some pretty decent moves during London, but lately I've noticed that it's been pretty slow. And I'm not sure if it's because summer is hitting, and the markets are moving a bit slower, but there is decent moves for US 30. I mean, honestly, with scalping, you really don't need to catch much points with US 30. So you can still find something during London, but sometimes I don't like if I see a setup on all three pairs or if I'm already in a trade on one pair. I don't really like getting into multiple trades at once, but if you're comfortable doing that, it's 100% fine. I usually find really good moves on US 30, the second half of New York. So London is 9 p.m. here in Hawaii, and New York is about two. I believe it's three actually. It ranges from like 2:30, lots of volume within the market before New York open, and once 3 o'clock in the morning hits, that's when New York opens in Hawaii. But by the time I'm up, because I don't like staying up that late, and I don't like getting up that early as well. So I will normally catch the second half of New York, and usually I'm able to find some pretty decent moves on US 30. Now, you don't have to just trade these three pairs. If you trade other pairs, it's completely doable with any other pair that you do trade. You just need to figure out what works best in terms of your session that you want to trade and your pairs. But honestly, I don't think that you should be trading more than three pairs at a time, in my personal opinion. I think less is more, and sticking with a couple to a few pairs normally tends to get the best results. So I kind of want to go through what to expect in this course. I mean, I wouldn't really call it a course, honestly. It's really just my strategy, my perspective on the market, and how I scalp, right? I just want to get right into it. I will, however, go over some basic foundation that is very key in my trading and super helpful. So if you are an intermediate trader, you should know, you should know basic price action, basic market structure, and you should be familiar with liquidity. Even if you aren't an intermediate trader and you are a beginner trader, it's 100% fine. Honestly, this strategy is so simple that even if you are a beginner, it would help you. You don't need to understand any other strategy out there. You don't really need to know too much because of how simple this is. Honestly, if you just look at liquidity, market structure, and price action the way that I do, you're able to gain consistent results with it based on, of course, your trading plan and your strategy that you're going to implement, your strategy in terms of like your system added on to this scalp strategy. So basically, you're going to be understanding how to scalp. I'm definitely going to be going over the foundation on how to understand liquidity in my perspective, how to understand market structure, a little bit more advanced market structure than the basic market structure. Nothing too fancy, just some added tips and a little bit more in depth on that. Understanding liquidity traps within the market, how to identify if we are experiencing a fake, break of structure in the market, or a fake area in the market where price is just having a draw on liquidity. And understanding entry points can be anything within the market, literally anything in the market. If you trade a certain concept, for example, if you are a trader that is very familiar with ICT concepts, then you would understand the basic terminology where your entry points would be at, versus somebody that does not trade ICT concepts. If you aren't somebody that trades ICT concepts and you trade zones or basic supply and demand, it's okay as well, because your entry points could also be called your supply and demand areas as well. Or if you trade break and retest, a lot of breakout traders, your entries can literally be anything. So the thing about me too, as in terms of terminology, I don't really like to use terminology in my trading. I do understand, and I have gone through some ICT concepts. I've traded supply and demand before. I've traded the breakout strategy before, trend lines and everything. And personally, for me, I don't really like putting a name on certain things in the market, but for the sake of explaining my strategy, I'll go ahead and explain it with certain terminology so that you guys have a better understanding of it. But just so you know, it could literally be anything. I don't want this strategy to change your entire way of trading. If you already have a system, and if you already have a certain way of trading down and you just want to add something to it, you just need something to add, to tweak to your trading, to take, then that's exactly what this is for. This is not to change up your entire strategy. It's only to better your strategy and overall make it your own. Because at the end of the day, we are individual traders. And I believe that we should all have our own unique systems and our own unique trading plans and ways of using tools in the market and how we view the market. So I still want you to keep a part of you within your strategy. So this first lesson is going to be on what exactly is liquidity in the market. So I'm basically going to just kind of go over the basic on what liquidity is if you don't already know. But liquidity is a, order flow and transactions between buyers and sellers in the market. The market does not move without buyers and sellers. Okay, so essentially you are the liquidity. We all are the liquidity. Okay, we're all retail traders in compared to all these bigger banks and hedge funds out there. We are considered retail traders, and without any buyers and sellers in the market, there is no liquidity. Now, the foundation of understanding liquidity is to always remember that the market is fractal. The same thing happens over and over again. So I need you to remember that. And this is really important in my foundation for reading liquidity. The market is fractal. No matter what, the same thing happens over and over again on all time frames. It does not matter whether you're on the daily. It does not matter whether you're on the 4 hour, the 1 minute, the 1 hour. The same thing happens on every single time frame over and over again. And another thing that is very important to remember is your entry point will always be just below liquidity and just above liquidity. So always remember that your entry point will always be just below liquidity and just above liquidity. Okay. And like I said, your entry point can be literally anything. So it can be an order block if you're used to order blocks as your entry. It could be a breaker block. It can be an imbalance. It could be a wick. It could be a supply and demand area. It could be a break and retest area. Your entry point literally can be anything. Okay. It doesn't even, if you see liquidity, and like I said, your entry will always be just above that or just below that. So whether that points into an area of an order block, however you want to identify that area, that will be your entry point. Okay. But let's just call it a point of interest because, like I said, I don't really like to label certain things. I don't really like have a certain terminology in the market. So we're just going to call it a point of interest for general speaking for everybody. Your entry is going to be a point of interest that you're looking at, meaning that it is an area that you are expecting reactions from based on price action in the market. And your entry point, like I said, is basically the closest to a draw on liquidity. Now, draw on liquidities, we have to also understand are traps within the market. There are a lot of them, okay? Not all of them are traps, but draws on liquidity are traps, meaning that there are fake trend lines in the market. There are fake break of structures within structure, and there is built up engineered liquidity created by hedge funds, banks, the bigger players within the market to drive price up or drive price down to a certain area or price, take out all those orders and reverse in the opposite direction, right? So we know that banks are able to hold these bigger periods and amounts of drawdown in order to collect all those orders and go in the opposite direction. And one thing to always note as well is, and this is key too, because if you're the type of trader that gets in a position based off impulse and you're not, 100% sure, I know that there's probably been times where you've entered a position and right after you enter that position, you instantly regret it. I don't know if anybody else has experienced it, but I have definitely experienced that before. You enter a position and literally right after you're like, why did I get into that position? Right? So a key thing to always note as well when your entry is kind of playing around price is kind of playing around and bouncing around your entry point is how do you know if you have the right entry based on just liquidity alone, right? So we're just talking based on liquidity alone. But how you know you have the right entry is if your entry just flies right after you've gotten tapped in. That's how you know that you have the right entry. If your entry just flies, your entry should fly, because if you are entering the market just below or just above liquidity, because all that liquidity and previous liquidity has been taken out, your entry should fly in the opposite direction, because the moment that banks drive price up to a certain area within the market or down to a certain area within the market, they immediately want price to reverse with volume. They immediately want that because they don't want anybody else entering the market. That's why they drive price with volume, and the market moves super quick in the opposite direction. But that's exactly how you know that you have the right entry. So if you get into a position and you're kind of dreading it, and you notice that price is just bouncing up and down on your area, your area that you just entered, if it's just kind of playing around in that area, normally what I do is I'll place my stops to break even if I see that it's playing around, especially on the 1 minute. You kind of have to give it some time on the 1 minute, just because what happens on the 1 minute, normally you can kind of see it happening before it happens on the higher time frame, and that's where things can get a little bit tricky. So on the 1 minute, there is a level of patience that you would need in order to see if it would play out on the higher time frames, right? So if it is on the 1 minute, and I know that 1 minute can be a little crazy, and maybe some of you guys have not even traded the 1 minute time frame before. So we're definitely going to ease into that. And I'll show you guys how to enter off the 1 minute. But if you do get into an entry, and like I said, if it's playing up and down between your entry, I would just place stops to break even. Once price kind of pushed up a little bit or down, place your stops to break even. And if you get taken out, you can always get right back in the position, right? But as long as you're placing your stops to break even right away if you see price kind of playing around your entry area. But like I said, if you have the right entry point, your entry should fly. So this is basically the foundation that we're going to be working with, guys. We're going to be working with how to read liquidity in the next video, but this is the key points that I want you guys to take notes on and truly understand. And everything that I said right here in this video, really think about it. It's actually a lot deeper than you really think, because the market is psychological. So always remember that. Your technicals are very important, but also remember that psychology is the most important thing here within the market, and being able to kind of control your emotions and understanding the players in this market. So be sure that you guys are taking notes in this course, and we'll get on the next video on learning how to read liquidity, and we'll hop into the charts for that.